James Halstead has never had it so good. The Manchester-based flooring group is sending more product to more places than ever before. It recently covered the Kremlin Conference Centre in Moscow and Melbourne Cricket Ground. Yet when it comes to managing its capital, the company prefers a more conservative approach. Still family controlled, investment in new machinery and research and development has traditionally come from profits earned rather than borrowing. Gordon Oliver, the company's finance director, says it has learned by experience.
I don't think it's any different than it's always been. You can't expect banks to hand out money. You've got to have a good project, a good plan, you've got to invest. Yes, we happen to be lucky that we've been making the profits to be able to reinvest, but 25 years ago we borrowed from the banks. We had a debenture, a mortgage, a recession hit in the mid-70s and the banks wanted their money back and we hadn't got it. And that's the situation people face today. We worked our way through it and we haven't trusted the banks ever since, and I presume that's what will happen this time round.
James Halstead, with its prudent approach, has had a good recession. But other companies which relied heavily on borrowing have had a tougher time. They include Findel, the retailer which, among other things, distributes the kit for Manchester City, the newly crowned English football champions. The company spent the early 2000s borrowing to finance an acquisition spree of businesses that failed to deliver. It came close to collapse after net debt reached £300 million, more than 3 times its market value, and lenders threatened to ask for their money back.
I arrived at the business in 2010. Findel had been pursuing a debt-driven acquisition strategy which had gone wrong, and as a result had a significant debt burden. So our first priority was to get control of the business and to keep it afloat whilst we focused on the longer term. To do that, we spent a lot of time micromanaging the liquidity of the business, spending a lot of time with suppliers, with lenders on a day-to-day basis, making sure that our cash flows were managed properly, whilst doing a review of the businesses to develop a plan for success for each of those businesses.
While James Halstead and Findel may be at opposite ends of the spectrum, a host of other companies in North West England and beyond are in between. The irony is that it's those most in need of additional financing that find it hardest to get a loan.
We're seeing the difference between firms that perhaps have more equity in the business, are less reliant on debt, against those that are perhaps more leveraged, who took advantage of easy credit prior to the recession. Those funds that are more likely to receive those funds from banks or other institutions are those that are well capitalised, whereas those that are actually more leveraged are the ones that are finding the challenge seeking more funds.
With banks more cautious and many companies unable to borrow, larger groups have built cash piles, waiting for an economic upturn before they invest for growth.
Well, the banks have stopped lending, and even when they are prepared to lend, they're charging extremely high interest rates, which means that projects don't become profitable. So as a consequence, many companies have decided to become their own banks. What they've done with their profits, instead of repatriating them to shareholders, instead of using them for new capex projects, they've kept them back just in case the banks don't renew their existing loan facilities or renew the overdrafts. If they've got excess cash, they've got effectively 4 choices. They can spend it on large capital projects, so they can invest in new processes and procedures, they can build new factories. They could increase their working capital if they think that the business is going to expand, but there's no evidence that that's going to take place. They can give it back to shareholders, or they can keep it behind as what they're doing at present.
After the flood of cheap funding available before the recession, there is now a drought. Those companies that remember the old adage, cash is king, are the ones best placed to lead Britain back to growth. This is Andrew Bounds for the Financial Times in Manchester.